again, why people put money in life insurance. It's one of the last holy grails of true tax-free safe haven. But if you're looking for income, because you have to think pensions are long gone. They don't exist anymore.
For most people, they're toast.
For most.
All right, welcome to the Advisors Collective, episode 4. Super excited about this one. We're talking insurance products, the IMO space, what it means to be in the risk management world. I'm with my great buddy, Walker Ham, Senior Vice President at Financial Independence Group. And this is going to be a fun episode.
I'm excited, man. Thanks for having me.
The only thing I'm a little down on is I'm from Indiana, where I'm in North Carolina right now, visiting you, and down here for other work. And we're doing this during the day, so we have a coffee and a water. When we're normally sucking on bourbon and cigars together. So it's a little different. But I also knew you weren't just going to be on one episode, so I was like, I'm not too bummed about this.
We'll make up for it.
Yeah,
later on. I'm not too worried about that.
We'll get around to it. So this podcast might then be more pointed to accurate information too. So it's probably good.
I won't have to make up as much stuff.
So cool. So you work at Financial Independence Group, or FIG is kind of. It seems like everybody in the industry just.
It's our website is FIG Marketing, and it's been that for a long time. Our logo, it says FIG on it. Whatever. We've been called FIG. I've been there for 21 years. We've been FIG, Financial Independence Group, the FIG, like the Ohio State. It doesn't matter. I mean, everybody knows kind of who we are, the name, etc. Whatever floats your boat, I'll answer to it.
So you said 21 years?
Yeah. So I was lucky that the founders. So we are still family owned and operated, which we'll probably talk about that later on in the show a little bit. But Bill and Erica Kane still own FIG. Their son Bo was in my fraternity. He had graduated before I got there, but he knew my actual older brother, who was also in the fraternity. And
at what school?
Appalachian State.
Okay.
So for those Michigan fans, you know who we are.
That's right.
And so we were in a fraternity up there. And long story short, I came home for fall break, October of 2002. And my brother said, hey, I'm playing golf with Bo. When you come home, bring your clubs. We'll play golf and meet you at this local uni golf course. Well, naturally in college, what do? You go out at night. You wake up the next day, you're late, you leave. I realized on the way there, this is like cell phone 1.0.
Yeah, 02, you got a flip phone for sure.
It was a Nokia, and it wasn't a flip, but it was a brick. It wasn't the brick.
Yeah.
But it was still like, those things are still existing today.
Yeah, if you were in severe trouble getting mugged, you could hit somebody with your phone.
Blunt object.
It's a blunt object.
And my brother called and said, where are you? And I said, I totally forgot. I don't have clubs. I got, I brain fart. My bad. So luckily, Bo had clubs. We tee off. And I said, are you guys hiring? He said no. That was the start of my interview process.
Forgot my clubs. I'm late. But I want a job.
Oh, man. Sorry. So throughout the course of the round, Bo finally said, why don't we do this? Send me your resume as you're coming down to Charlotte, and their home office is in a small suburb called Cornelius, which is, if you're in the Carolinas, it's on Lake Norman, very pretty area. It's blown up since I've been there, the area. And he says, if you're coming to Charlotte for interviewing jobs, we'll interview you, give you experience, give you feedback. I was like, that's pretty cool. And lo and behold, as the interviews kept coming, I would come visit my brother, see them, see other jobs I was interviewing. They said, I think he called me day 2 of my exams and was like, we're going to take a chance on a new endeavor in our firm with you. Cool, let's roll.
What was the new endeavor?
One that didn't last, but for a couple years. So, FIG, see, I can't help but say it myself.
Right.
And its most basic functionality was started as what is now called an IMO, They wholesaled annuities and life insurance and asset-based long-term care. Back then, it was traditional long-term care insurance where you're paying premiums. Think of the Genworths and that kind of stuff.
Yeah. That stuff's pretty much dead now. But
They were also an OSJ for what at the time was called U.S. Allianz Securities, which was Allianz Life's experience into the BD marketplace.
Okay.
We were trying to, myself and the guy named Richard Harvey, who is the 24 licensed advisor, we were trying to recruit registered reps to U.S. Allianz through our OSJ.
Got it.
And it was fine, but when you have a firm that is backbone was about risk averse products, to try and get into that space, it was fine. It just didn't work out the way they had hoped. Luckily for me, I transitioned into the annuity insurance space about 2006.
Okay. So it's right when I got started in the industry. It's January of 2006.
So I just hit 21 years this February, which is still crazy to think about. I was employee number 27. Now we're pushing 200.
Wow.
So it's been a pretty cool ride.
That's awesome.
Yeah.
So they're still known as an IMO, though.
We are. There's a million different ways guys call it. We can get into a little definition, which is kind of getting the weeds, but I'll break it down for you. So Allianz Life used to have IMOs they owned in entirety. You had some carriers that owned IMOs.
Yeah.
They actually just sold off their entire IMO block to a PE company. But Allianz defined it as an FMO, aka a field marketing organization. That's a wholly owned shop by them.
Okay.
An IMO is an independent marketing organization. So we offer Allianz Life, but we aren't owned by them. You've also heard NMO.
For years, I always thought those two terms were almost synonymous.
They really are nowadays.
Yeah.
It's just how Allianz would define it.
How the carrier would define
internally.
it. Internally. Got
Most
it.
other carriers didn't matter. There's also NMO, National Marketing Organization, BGA, Brokers General Agent.
Okay.
It's all the same stuff.
Got it.
Tomato, as I say to people.
So you've lived through, 21 years. How much has the industry changed in the 21 years?
I predate the iPhone. Let that sink in for a minute.
Yeah.
The first iPhone came out and I had a BlackBerry with all the keys on it.
Yeah, for sure.
And I was like, who would want that iPhone? It didn't even talk to Outlook properly. Now I couldn't imagine having anything besides the iPhone.
Right.
I predate, this is funny, I predate Facebook being available to outside university people. Remember that?
Me too. I remember I'd have a Purdue.edu, boiler up, to get Facebook. Which, we're, Advisors Collective is a lot of, I would probably say more the millennial and Gen X advisors in the world, but for the high Gen X baby boomers, I don't know how much they back then were probably in social media, if at all, but almost everybody is now. But the phone changed the industry too.
Oh yeah.
Because you went from the desk, the hard line, call centers, boiler rooms in New York City, all that kind of stuff, to like reps were on the move.
Yeah, it's funny you mentioned Boiler Room. That was the movie. Like when people asked what we did, I was like, pretty much that, but it's legal. Like
right. Giovanni Ribisi, great movie.
One of the best sales movies of all time. Vin Diesel, Ben Affleck.
Oh, yeah.
Affleck gave some of the best recruiting speeches you've ever heard in your entire life.
I used to watch a couple of his speeches when I was 21 when I got started. Actually 20, it was just for my 21st birthday. And I would watch some of those speeches to get myself fired up.
Oh, you get fired up?
Yeah. You say, I got a Ferrari, 355 Spider. What's up? Throws his keys across the counter. You're like, what a baller,
So many epic scenes in that movie that, like, again, a lot of it, you think guys my age, it was Glengarry Glen Ross, Wall Street, which was another great one. Then you had Boiler Room, was like the new version of that was kind of hip to our age.
Yeah.
The all black suit. Giovanni was dressing like a good fella.
Yeah.
But I was like, man, I like that look. You go to Banana Republic, you buy a black suit, you buy the Regis Philbin shirt and tie combo. You were a baller.
You were ready to go. You were ready to go sell some insurance, which is how I started. So at 20, 21, I got life licensed January 12th of '06.
Okay.
And I was purely in life insurance for 5 or 6 years before I got into BD.
Yep.
Looking back, I always wished I would have gotten into it faster, but I was good at selling insurance, so like, it always felt like, well, why go study for another license, and then I got into BD and then RA later.
Yeah.
The story. It's almost a progression of all reps in some capacity.
I mean, think about it. Most advisors that are still in the business today who are like, like not quite our father's age, but in that demographic, they're boomers.
Yeah.
They started out at a major wirehouse, Jefferson Pilot. We're here outside the Greensboro area. JP was huge. Now it's Lincoln Financial. You had the New York Lifes, the Mass, the Mets, and those other major wirehouses.
Yeah, right.
And you sold that product. That was all you had. You didn't think, oh, what if I had other ones to offer? But most of them got that training. They cut their teeth that way. They were on a draw. They were doing, was list billing? I mean, all kinds of stuff where it's like.
My mentor was from the era where advisors would collect premiums. Or not the advisors.
Go to the house.
Yeah, but the insurance guys, dude, go to the house. Like, my old neighbor was a Prudential guy back in the day, and they'd collect their own premiums door to door.
I always think about door-to-door, like any kind of door-to-door sales, Cutco knives, anything. If somebody rings your doorbell, now, if they ring my doorbell, all my dogs lose their mind. But if somebody rings your doorbell now, you're kind of like, you're not happy, you're almost concerned.
But who is that?
Yeah, because I'm like, who comes to the door anymore and knocks on the door?
Right.
But back then it was like, that's just what you did. You didn't have phones. Oh, you had phone, you had a landline.
Yeah, but we're old enough, like I'm 39, you're 40.
43, I'm 44.
44?
Gosh.
We're like old enough though where you got on your bike and you just rode to your friend's house to see if he was there.
Yeah.
And you knocked, you're like, Mrs. Jones, is Bobby here? And it was like, no, he's gone. Oh, shoot.
All right,
So, I'll go find him. I mean, then you just go to the next potential place.
Yeah.
Slowly work your way down to the park in town, and then you find all the boys, playing ball or whatever it was, right? But that's almost like our industry's gone through something similar to that. So, I mean, it's not off topic. We used to have Rolodex boxes with like follow-up cards, where you were like, okay, call me on the 5th. I used to have dates in these cards, I'd put on the 5th of the next month, and it's how you did follow-up.
And business cards where you would like physically hand out business cards. And I was like, I have them now at my desk. I came here last time, I was like, here's my card. I don't,
Yeah.
You're right, exactly right. Rolodexes. I remember we first got like a dialer system where you click the link on your computer and it dials your phone.
The first voice over IPs, those original,
We thought we had made it. We were like, look at us. We are awesome.
So back then though, like, to take it back to the insurance side, back then the rep would meet with the client in-house a lot of times, or in office, right? In-house, or one of those two. You pull out a paper application, let's say for an annuity or a life policy, sign here, press hard, third copy's yours, like NCR paper.
Yeah. The carbon copy.
Yeah. I mean, literally, like, one of my lines, like, press hard, third copy's yours, like, kind of thing. And we moved from that, and then like Blackberries and Palm Pilots came, and then
Palm Pilots.
And then it was kind of like e-apps started. If you were at the right place, they started to become a thing. How much do you think? I mean, because you were in the space. How much did that change? Did it change volume? Maybe that's my question. Like, if you had a top producer, did he produce more because the app process got better? Did it really not?
That's a good question. It did a couple things. One, it made life so much easier. I mean, this insurance system, insurance advisors, even the insurance industry, old school. They buck hard at new things.
For sure.
E-apps was like, and again, when you first rolled it out, it's the beta version. The bugs aren't worked out.
Right.
Now that it's become more commonplace, you have advisors writing more than they ever have before. I'll give you an example that happened this week. One of our carriers had a massive change to their income rider. They were the most competitive rider in the marketplace for joint income.
Okay.
Which is most cases we see are IRA covering a husband and wife.
Right.
Both get the income. They went from number one, they dropped a bunch. We had one advisor that dropped in 20 apps in one day.
Personal.
You aren't doing 20 apps on paper. You will have carpal tunnel on your hand. Like you
got to claim your disability insurance.
That was just one advisor that I work with. Another team that sits near me got in 74 applications from 2 offices in one day. The advisor's up to 3 a.m. typing. It's still a process, but
For sure.
you can't do that on paper.
Right.
And then what do you, FedEx a box? Like, so carriers became more efficient. Advisors became more efficient. People get policies issued faster. Clients get policies faster. Advisors get paid faster. The other thing it did was it got the traditional, I don't like insurance guy to consider our space. The fee base, the broker guys that were more equities in nature, the guys that were only doing, ETFs and mutual funds are now like, oh, well, this isn't that much of a process like it used to be.
They saw the hurdle became a little lower, and they were more likely to do it. You want to talk about old school? I want to stay in the vein of the fee-based guys in doing insurance, but I had apps. Companies pay a bonus. You do enough business, you get a bonus, that kind of thing. So I was in my shop. I was a junior to my senior advisor, right? Yeah. And I wrote a bunch of business. I wrote 5 or 6 apps in one day at the end of the month. It was month end, and it was month end of this deal, some contest and bonus with a particular carrier. And he bought me a plane ticket from Chicago Midway to the carrier because the apps weren't going to get there fast enough on overnight. They had to be there. I wrote some apps that night. The overnight wasn't going to make it. So I literally drove to the airport with a stack of apps, got on a Southwest plane, flew there, got a rental car, took them in, handed them to the processing operations team at the carrier, and I was like, peace. Went back to the airport, got some dinner, a beer, and flew home. So
that's pretty good. That's pretty good.
When you talk about old school to new school, we were doing that kind of shit because you were like, oh, this is what you'd got to do to win sometimes.
We did a few same day deliveries, and those, that ain't cheap either.
No.
It's less than I don't know, maybe less than a plane ticket and all that stuff. But at the end of the day, if it was a couple $1 million in premium for annuities, and you're going to stand, the advisor's going to make X, the IMO's going to make Y, you do it.
Yeah, you do it.
Because you can't tell your advisor, sorry, we're not going to get this out because it costs this much money when you stand to make that much.
Right.
They're going you pay it. You do it.
Pay it.
Yeah.
But to think that that's gone, drive to the airport, flight, rent a car, lunch and beer out while you're gone, dinner kind of thing by the time you fly back. Because I don't care where, if you take 2 flights in the same day, it's the whole day.
It's the whole day.
Okay.
No chance. But at least back then, you didn't have all the crazy, you didn't have TSA as bad as it is.
Right. I was
through security pretty quickly.
I was Chicago to Atlanta.
Okay.
It was a couple hour flight. I mean, my day was waxed by the time I get back. And so you think about that. It took one of your sales guys out for the whole day. And to think that that's a digital app, it wasn't much longer after that where digital app was in, e-sign and so on and so forth, where we were at. And that expense was gone. You're just that much more profitable, that much faster.
Much more. Well, I think about not the insurance carriers really care about being green, but the lack of paper you're using, which is one part. But the carriers love it. They give preferential treatment to e-apps. They go to the top of the pile versus paper apps.
For sure.
They offer incentives to do e-apps. I have one firm that was running a lot of business, and they're like, "What can we do to make them write e-apps?" So we flew there, sat down, showed them, and they said for every e-app you do, it's an extra whatever % in commissions.
Yeah.
For them, it was worth it because they're getting that much more
savings on the back end.
Yeah,
their operations people have got to process.
Yeah, so my advisor was like, I can do this. Oh, no kidding.
Yeah. We get paid for it. Now you can do it.
Now he's like, I should have done this so long ago, but I'm enjoying the extra comp. It was a limited time thing, but still.
Right.
For the 6 months,
they just need to get them hooked.
Just got to get them on it. Yeah.
So earlier you started to say this. The broker-dealer guys probably were, I think, less because they were commission. you're broker dealer, you're in the commission realm, you're selling A shares, B shares, kind of thing.
They know the hit, yeah.
You're always kind of like, insurance was, at least when the world I came from and the guys I knew in that world, the BD guys were always cool with insurance because they're in commission. But especially as like best interest came in over the last few years, fiduciary standards started to change. I meet a lot of RIA fee-based only thinking guys who they poo-poo all over the insurance space. And they're like, oh, there's no need. You can do that without insurance. They have a lot of belief systems that insurance doesn't still like have a place. I don't agree with that. But like, where do you think that comes from? Like what I don't know. You know what I'm saying? Like why?
Yeah.
And how do we get past that? How do we get fee-based guys understanding?
It's tough. A lot of the carriers consider that the blue ocean. They think the fee-based marketplace is how much they control of the wealth of America is with those type of advisors. It's a great question. I think the first and foremost, being electronic was great. The issue you have with fee-based guys and anybody writing insurance, you know this, you write a life insurance app and you get it in and then this pops up. That drives anybody insane, especially them. On the annuity world, while they're fiduciaries, they're legal fiduciaries, because they're 65 licensed. They have to wear that hat 24/7. Then you have somebody in suitability saying, hang on, at the insurance carrier, saying, we don't like this. Who are you? So they want to have complete autonomy, and you're not going to. That's my 2 cents. The other thing is this. Most advisors, most of them aren't doing their own asset management. They're doing asset gathering, but they aren't tinkering with stuff. Those that do, they're used to click, rebalance, or I got to move positions to cash, whatever, and it's done. Annuity apps, life apps, even with electronic, it's faster. It's still 40, 50 pages. There's a lot of redundancies. You're using replacement forms when you're not replacing, only because you already own other life insurance or annuities. So things like that are where they're like, I don't want to deal with it. Yeah. Which, in my opinion, isn't right, but it is what it is. Right. That's one part of it. You mentioned them earlier about I can kind of build a synthetic annuity in my portfolio. Right. You can, but are you going to mark that guaranteed? At the end of the day, you use insurance for pooling of risk. That's what they do better than anybody else. Insurance companies are what bailed out America. It wasn't AIG, it was American General Life. Right. Is why they bailed out AIG. They have to hold so much more money in reserves and all these other things. Anyway, long story short, that's huge though. The insurance companies have all the money. They've been around in many cases for well over 100 years. Well over a lot of these brands. And they know how to mitigate risk better than anybody. It's what they're really, really good at. Better than anybody. When you dissect how an annuity is really funded, and we may go into this in more detail, but banks can take your $1 million and loan it out 8 ways a Sunday. An insurance company has to keep over that in reserves. That's why solvency ratios are 110%, 108%. They got to have every dollar accounted for and then some. Right. So it's a lot different ballgame when they go, I can build that thing. It's mostly going to be the equity with a fixed income, aka bond position, and you kind of float in between based upon volatility. That's not rocket science, but you can't guarantee your clients won't lose money. Well, no. Look at this week. We're in the first week of August 2024. It's a little rough. A little rough. Monday and Tuesday were scary. Yeah, and I think if you have clients, that's why my contention that with fixed products or insurance products is you're just taking some of the risk off the table. Yeah. Like, why is that? I don't understand why that's so bad. And how, as a fiduciary, you're not doing what's right. Yeah. And again, a lot of it's just a negative connotation. I'll give credit to the CFP board. They've done a great job convincing you that if you make commissions, you can't be a fiduciary. If you make commissions, they're convinced that if you're making commissions, you cannot do it in the client's best interest. Which anybody that wants to legislate morality, good luck. Let me know how it works.
I think that's total bullshit. And the reason is I hear fee-based advisors always say the direct opposite. Because they always say, oh, well, you make a commission on that of $10,000, but if it's over here in fee, over the next 3 years, I make $30,000. Oh, wait.
Your money.
Oh, wait. So you're not thinking about it as what's best for the client. You're still thinking about how you're going to get paid more over a longer period of time. Sure, it's over a longer period of time, but you're still thinking about the cash, dude. You're not fooling anybody. Like,
no, you're not. And I'm not, again, they're not bad and they're not wrong. It's just, they're, for whatever reason, whatever they learn, you think, when you're studying for your CFP, you're studying for your 65, the insurance section of those guides is probably 4 or 5 pages. It's not a whole lot, unless you've gotten your insurance license and been in the business, you just don't know.
Right.
So it's hard to say, again, they're not bad guys, but to your point earlier, it's like, you're saying that because the insurance carrier is going to pay me 10 grand of their money, that's bad. But you're going to charge your client a point on $1 million portfolio, which is $10,000 a year of their money. Where's that point coming from? It ain't coming from Schwab or Fidelity.
Right.
It's not coming from whatever mutual fund or ETF you're in. It's coming from the client's portfolio.
Right. And this is an argument that fee-based isn't good. I own an RIA.
I'm a licensed advisor myself. I mean, it's like,
Right. But it's just an argument to me that risk management still has a place. Insurance companies still have a place in portfolios.
Yeah. I mean, I tell people all the time, the insurance world is where the uber wealthy put a lot of their money. And they do it because you saw it with, you talk about the BD world, back in the day, it was, God, what year was that? Had to have been 06 or 07, I think it was 05 actually. Notice to members 0550 was when they first started to tell BDs, we recommend you start looking at these index annuities. It was never like their security. They tried that too, it got voted down. The money in the insurance industry is big from the carriers because how much, again, like casinos, they aren't that big because they lose money.
That's right.
They're good at how they invest. They invest in boring stuff. They don't take risk. It's all pretty well done. You've only ever seen a handful of carriers really fail.
It's very small. I mean, they own a lot of long-term assets and a lot of low-risk assets.
It's all predictable,
for
boring
150 years. So compounding means
it's doing its job.
They've got a lot of money.
Yeah.
Right, that's right.
But yeah, I mean, I'm with you. It's kind of like there's a place for everything. There's a place for all these things, and to say, well, that's just bad. No, I don't think there's bad products. There's bad advice.
Right. So I came from like a term world.
Yeah.
Okay.
Buy term, invest the rest.
Buy term, invest the rest. A portion of me literally morally. I mean, because when you live that way, you listen to Dave Ramsey, and you live on like this like moral superior like high ground, and then if you get educated at all beyond the framework that basically you're being told, if you do any of your own research, you start to figure out pretty quick, this works for this percentile of America, blue collar, kind of what, high liabilities, low assets, young families, that kind of thing. Term is a really great answer for this large percentage of people. And it is a big percentage of people.
It is.
But then you start to run into scenarios where you're like, okay, so you're maxing your Roth and you're out of debt and you guys have no way to tax shelter any money any longer.
What else can we do?
And you just start adding up like non-qualified money and you start to try to solve this stuff with tax-aware investments and all these other things. And you just go, like putting some money in like an IUL might make some sense. And then all of a sudden you start to, in my case, I started to like morally come up against like a roadblock that I realized I wasn't doing what was best for everybody. And the math just plays out in the right direction. So I do want to end up talking FIA, but it's hard to swallow when for so long you really have this one belief pattern, and then you go, well, there's been a lot of situations where I probably didn't do what was 100% right, and you're only doing, I mean, you can only, any advisor today, tomorrow, that's why partially for the podcast, is like you can only do as much as you know.
Yeah.
Right? Like you are doing your fiduciary standard based on your education, and then hopefully you're getting more and more educated all the time so that you do better. Right?
Yeah.
We all got to improve.
It's also, you can't be all things, all people.
Right.
I mean, at the end of the day, like when you,
100%.
like, I do think there is a massive shift. We talk about this a lot is, you know, the general public does want to go to one place, one guy, one girl, to be that holistic advisor. Maybe you don't have all the answers, but you know the guy. You know, hey, I'm not going to be your attorney, but I have an attorney. I have a CPA. I have a tax professional. But they don't want to have to go like, here's my insurance guy, here's my equities guy, here's my stock guy. It's like, so you can't be all things, but you at least need to be aware of it.
Yeah.
You know, it's kind of like, I'm aware of X, Y, and Z. Like, I'm aware, you know, you shouldn't smoke, so I don't. You know, it's like being aware of these things. So I think that's the biggest hurdle is making people aware of these things and knowing enough to at least be educated themselves. Do you want them to be a technician? No. But at least to say, you know, hey, Joshua, here's why an IUL might make sense.
Yeah.
Boom, boom, boom.
I mean, there's different products, permanent stuff. You just talked about some of the wealthiest old families in America. That was one of those things I started to do research on years and years ago. I only started my own company in 2022, where we started our RIA and moved out of where I was at. But I remember it was Trump won, so pre-2020, right, 16 to 2020. I remember there was it came out in the Wall Street Journal, I believe is who put this out. And it was Jared, I'm forgetting his son-in-law's last name, but Jared, who married Ivanka, his financial statement, they released it for some reason, or he released it for some reason, showed his assets and liabilities. And on the balance sheet was cash value life insurance holdings. It was a pretty big number. Now, in the grand scheme of his assets, it was small, but it was 5% or so of his total assets, right? And there's a huge amount of assets in commercial real estate in New York City and blah, blah, blah. So these are big numbers. And I remember sitting there and I read that and I went, this guy's not dumb.
No.
Okay?
He's not.
This guy's not dumb. You look at his assets, his age, so on and so forth. You can politics, take that crap out. Just, let's be honest here. You look at somebody that's got an ass ton of assets and they're rich, they're not dumb. Okay?
Yeah.
We all know how hard it is to make, save, and create more money, right? Let alone multiply it.
Yeah.
And this guy's got a bunch of cash value, and all of a sudden something in my head went, these people aren't stupid. You can't say they don't know better or they were lied to. People at that level, I started to learn, the higher up, they understand their financial products they own and why. Like they get it. It's not that they were sold and they're just like dense. They understand it, not at the level the advisor necessarily does, but they do get it.
Well, a couple of things on that one. You know, it's funny. I remember that when that came out. Everybody's like, "Whoa, what's?" I'm like, "Yeah, that's cash value life insurance."
Yeah.
If you look at like Kennedy's statements from over their family and that wealth, the Bushes, think about the historically wealthy families that are
older money,
yes.
2-3 generations.
Yeah. You're exactly right. I mean, they see what it is. With the uber wealthy, it's the hard part. What we found is once you get them to sit down and listen, they got it. It's just getting them in the room to sit down and to give you undivided attention.
And that's probably because they're busy, and everybody's a shark, so they don't know the trust factor comes in, relationship, and so on and so forth. But what are they buying? Like, how do you structure this? You're talking about 2-3 generations.
Yeah.
I mean, we don't need to do a clinic on this.
Yeah.
But roughly, how do people do this generationally?
There's a bunch of ways to do it. A lot of them have some type of family trust. Okay. I had a really good mentor in the business, mutual friend of ours, Charlie, who said, you know, the reason you would do revocable living trust, any kind of trust, is you get privacy, avoidance of probate, and protection. What do wealthy people want? They don't want their business in the streets.
Right.
It already is. We know Elon Musk is worth how many billions of dollars, Bezos, etc. But a lot of time when that stuff happened back in those days, you didn't have social media and X reporting about how much money they were worth. You didn't have a Forbes list. The Rockefellers, everybody knew they were rich, but they didn't want everybody knowing all their business. So trusts were involved a lot. They would have life insurance, and they would insure so-and-so, and they could put as much money as they want into those things. there was a limit up to, as we know, the modified endowment contract line.
Right.
And all that does is turn your life insurance into an annuity. You still get a death benefit, but the reason they would do it is they can put as much money as they want to in there. There's almost no limit, and then it pays out tax-free to their heirs. So
you're saying the death benefit or the cash?
the death benefit. So you pumping $1 million into a life policy and making it real simple. Let's say it buys you 10x that in a death benefit. So $1 million, let's say easy math, $10 million of death benefit goes to your 4 kids. They each get $2.5 million tax-free. Doesn't go through probate, doesn't go to a court. It goes from insurance carrier XYZ. If there's a trust involved, it pays the trust then pays it out. Or it pays you directly. Either way, you're not Uncle Sam going to touch it.
So how do they keep that going? So the old man dies, $10 million pays out, $2.5 million to the 4 kids. Do they then take part of that $2.5 million and buy a policy on themselves or their kids? Like, how do they keep it moving?
Yeah. Again, that depends on the person that helped write the trust, what the control from the grave, as we call it, was designed from the original grantor trust creator.
Yep.
So you could say when this comes into play in the trust, it's then going to then do the following: force each kid to buy, so on and so forth.
What we call dead handing.
Yeah, exactly.
Yeah.
Ideally, if you're a good advisor, the kids, the beneficiaries, let's call them, could be adult children or whatever, are already clients.
Right.
You're hoping that they don't take their money and run to their buddy who just passed his test. We always hear about that story.
Yeah.
You want to make sure they're clients as well, and they're already having things insured. That money comes in, they just keep rolling it, and generationally into different.
So people can buy large policies on their kids, and then they load them up. And we're not talking about middle class people here. We're talking about people with significant assets.
And buying a kid is a great idea because their cost of insurance is dirt cheap.
Right. So you have a long time before cost of insurance becomes part of the conversation.
Exactly.
Because it's so cheap.
Yep.
They're pennies per thousand.
Pennies.
Yeah. So you can just load it up essentially early on. And that's what the thing that from the world I came from, that Dave Ramsey philosophy, if you will. That's not a conversation that you need to have with the family that's making $90,000, $100,000 a year take-home pay, because they don't have that problem. But when you start to get into people are making multi 6 figures, 7 figures a year, and they're just paying taxes out the nose.
Yeah.
They have nowhere to hide money anymore, and they're going, we want to save a lot of money. What do we do now?
It's tough.
It gets really tough.
I know we're going to talk about this later on, but there's a guy I've known for a long time named Dave McKnight. He's wrote the book on tax planning and using life insurance as part of that.
Okay.
And one of his philosophies is, and he preaches this in his seminars, is America has a giant math problem. When you look at what's coming in and what's going out, it doesn't even come close to being on the same plane.
Balance sheet.
At all. If any corporation ran their books this way, you'd be done. So, what you're seeing is, and with the estate tax law changes coming down the pipe, where they're lowering, it was 11 million, now it's going to be like 5 or 6.
It's going back.
Which used to be like crazy, like $5 or $6 million, but so many more people have close to that much money in today's dollars, where in 5, 10, 20 years from now could definitely be above that. Taxes become a real problem. And, listen, do taxes affect the uber rich? Yeah, somewhat. But when you have a couple $1 billion, you're okay. When you're worth 3 or 4 and they take 40%, that's a big chunk.
Right.
And so I think what you're seeing is these people are looking for ways to say, okay, how can I keep more of what I've brought in? How can Uncle Sam get out of my life? Dave Ramsey, we make jokes, is a good plan for that lower middle America, which nowadays is really a combined income, believe it or not, I think in my opinion, under 6 figures.
Yeah.
You say, if you make 6 figures, you're top 1%.
Not anymore.
Not anymore. I think it's definitely shot up a lot, but those families who are even in the $500,000 to $1 million range are getting pinched.
Oh, yeah.
This is my soapbox and my tinfoil hat. You look at the cost of insurance, the cost of medicine, and the cost of college, and how all these things have skyrocketed compared to the incomes we all make.
Yeah.
It's just everything costs more.
Right.
And taxes aren't going to go down. If you're going to vote and any politician is telling you taxes are going to go down, don't believe that. They can't.
Right.
I mean,
Yeah, well, that's that gets into the whole, what do our tax dollars actually pay for, and so on and so forth, right? But I don't know, that discussion of long-term wealth management, I think is just such a fascinating conversation for advisors to get into, because if you want to move into advanced market planning, planning, you have to understand the risk management element, because it's like Merrill. Merrill built their shop on bonds, on fixed income.
Yeah.
They were basically a fixed income shop for people that had a lot of money already. It wasn't really accumulation. Because you just go, hey, how can you get me 3 to 4 points a year on my $3 million? I'm going to take out $100,000 a year in income.
Done.
Thumbs up. Appreciate you, buddy.
Here's a 30-year bond. Talk to you in 3 decades.
Exactly. And you just, like, done. There's entire companies that built on that basis. But I think now, if you're really being a fiduciary and you run into the guy that's got a $5 million net worth, and he's got a large amount of money and qualified money because he had a great 401k for years and he just stacked it, and he was an S&P and he rode the last 30-year wave.
Yeah.
Right? And then he's going, 73 is going to be up here in 10 years, and I'm going to be taking a bunch of distributions.
All taxable.
Like, how do I limit this challenge long term? And then on top of that, when I die, how much is this going to cost my kids?
A lot.
Like, how much am I going to pass down?
Yeah.
And it's like, well, sir, it's going to get beat up pretty hard.
Pretty hard.
You know, like,
Pretty hard.
Yeah. And how are they going to pay for it?
You're in a 50-50 relationship with the IRS. Ed Slott famously always says that in his IRA classes. If you never watch Ed Slott, he's on PBS. He's great. He's not like, you're not watching him because he's riveting, but his facts are there.
Yeah, yeah.
How excited can you be about taxes? But, you know,
a little hard to get fired up about it.
He does a great job.
Yeah.
But, you know, he talked about, he's like, you know, again, same thing for the wealthy. Like, the wealthy can stand to lose money. You got
it's a different story.
Oh, I lost 5%. You still have $80 billion. You know, but like at the end of the day, they hate taxes because they look at it and go, tax is theft. They all believe that.
Right.
You know, so the way you can help them get out of those brackets and get Uncle Sam out of their life as fast as possible it is a lot of it is tearing the Band-Aid. You're going to pay this today to never pay taxes ever again on this money. You Roth convert.
Right.
You know, I think it was George Bush's presidency that lifted the income limit on Roth conversions. So it used to be if you made over 6 figures, you couldn't Roth convert. Now everybody can.
Yeah, right.
And that's where, in your analogy there, you would obviously help somebody say, okay, your income is X, you're in this tax bracket, we're going to convert this much of your 401k or qualified money to the limit of that tax bracket every single year until we can get as much as we can out of qualified, where, you know, it's all taxable.
Right.
So you just kind of, that way you're paying ordinary income tax on this much money without paying a bigger bracket.
Yeah, right. So
bumping the bracket, we all familiar with that way.
Right.
It is. That's my number one fear, and thing I try and do personally. Any of my investments is I want them to be in place where Uncle Sam won't touch it.
As much as possible. Which
getting harder and harder.
That's right. Which is like one of the pros and cons to if you're financing with a LIRP, right?
Yep.
The life insurance retirement plan. You're going to have to buy more and more life insurance if you're dumping more and more. If you want more to go to the savings, you got to know that you're buying more thousands in death benefit because you got that corridor challenge with the IRS, right? So it just depends on the situation. Sometimes it's good for somebody, sometimes it's not. I mean, just like anything else in the world of all of our products and services, right?
I mean,
that's what planning's for.
Again, back to the whole trust thing earlier is like, you know, you think, oh, if you have a trust because you're wealthy and you're really rich. I think most Americans should have an RLT, which is, revocable living trust. Most of them should have that because at the end of the day, when you pass away, you don't want your kids going to court and fighting over whatever.
Even the middle class should invest and just get that done.
And you hear, like, we used to have these things in the office, like failures in estate planning, like famous deaths, Whitney Houston, Heath Ledger, who had no plans, Prince, that had 45 wills. If you have multiple families, because you've had multiple wives, wills are contestable in court.
Right.
Trusts aren't. If I have a trust, it's done. So I think most people would, if you understand that you can get a trust done for under $3-4 grand, maybe doing even cheaper now on web.com or what's it called, LegalZoom.
LegalZoom.
But to do that and then put some assets in there, that way again, it's out of the courts, out of probate, it's protected, it's private, all those things are like, it makes more sense. It's not just for the uber wealthy. It's now become commonplace for everybody.
Right. So.
More of my soapbox, sorry.
No, I love it. It's crazy. I've been like in a frenzy of learning those last couple of years just because the space I came from, and then you jump to the other side and you're like, oh, well, this is different than what I was told.
It's like when Neo gets unplugged.
Yeah.
Like, oh God,
I'm out of the Matrix. This is
using my eyes for the first time.
Holy shit! People don't like paying taxes. You can actually figure out plans not to. Let's not. Oh God. This week, crazy week in the market. Mentioned it earlier.
Yeah.
Crazy week. Interest rates. There's all the conversation if we're going to lower rates or not, how much longer we're going to be at where we are from the Fed's rates. FIA's been big, right? The last couple of years.
Whew, yeah.
Because the interest rates are up, right? So let's talk about that. Like, why is fixed indexed annuities right now still a good play? Why is it good for your clients if you're trying to like? What are the benefits? Let's just say that without me saying it.
Yeah, so in its basic functionality, a fixed index annuity is an insurance product. It's backed by the insurance company, which means there is no market exposure whatsoever. That's how you define a security. Who bears the risk? If you go buy Apple stock and it tanked, which it dropped 5 or 10% Monday, I own Apple stock. That's a security. It's who bears the risk. So fixed index annuity, the old term, which is what changed back during NTM 0550, all this stuff was equity index annuity. Well, they don't have the word equity on there, so they made a fixed index annuity. Again, like IMO, FMO, tomato, it's the same thing. It is an annuity product, which the old way annuities worked, where you'd pump money into it, eventually it creates a pension. You annuitize it, and you have an income stream for whatever period you want.
Right.
It can be a
10-year
10
lifetime
years,
certain,
it can pay
whatever.
the rest of your life. Think about you win the lottery. You get a lump sum that's going to have half go to Uncle Sam, or you get an annuity that's going to pay you whatever amount for the rest of your life. But as soon as you die, it's gone.
Right.
Which, has become less and less of an ideal place. And so now index annuities, and fixed as well, are more of a place to park money to grow in a safe manner without market exposure. So as you're nearing retirement, so a lot of boomers, 55 and up, 60, 70, whatever, are buying these because they still want to get, the old term was market-like returns without market risk. That became, you can't say that anymore.
Right.
But basically you're going to get, and this is what I heard from an actuary at one of the largest insurance companies on the planet, said an index annuity should earn you whatever the 10-year treasury's at, plus 2 to 3%.
Okay.
Right now, we're in the 4 range, I think, on the 10-year treasury, which is fantastic. We used to be real low.
Right.
I mean, it was down below 2.
That was 1.8.
It was 1.8 one time.
Yeah.
So you take a 4% 10-year treasury, your index annuities over the length of the contract, 5, 7, 10, how many years you own it, should earn you that plus 2, 2.5, 3%. Not per year. Some years are going to have a 0. But here's the deal. When you're retiring, think about you're retiring in 08. Markets take a bath during the mortgage collapse. You lost 30%.
Right.
You don't have the same time frame to make that money back up. So you want to take money off the table. That's all you're doing.
Yeah, you're not talking about the whole thing, but if 20% of my portfolio, I throw to something like that.
Yeah.
I got this other portion in fixed income, in fee-based RIA. Maybe I got this other portion still in equities, but I'm taking a portion off the table. I'm returning 4+% in this contract term. They also have income riders though, right?
Yes. So that's another, I think that's where they shine more than anybody else.
More than a VA?
Yes.
Yeah.
Especially now, with rates where they're at, even when they weren't there, the guarantees and the low fees compared to most traditional VAs. And now you have these things called RILAs or IVAs. We can touch that in a little bit. But if you're looking for income, because you have to think pensions are long gone. They don't exist anymore.
For most people, they're toast.
For most. You still have some government employees that get them, teachers.
Unions.
But even then, when you get your pension quote, most of them, the pension company isn't managing that pension once you leave. They're outsourcing it to an insurance company to sell you an annuity.
That's right.
We can usually beat them with an indexed annuity. It's okay, your pension's gonna give you this much money for the rest of your life. We can do the following. And we usually get them more income, or we can give them the same income with less of the asset. And that's where I think most fee-based advisors need to start looking at the indexed annuity as an income solve. As your clients start to retire and they take income off of their assets, unless you're matching the income with performance, you're decreasing your value of the book. So if I can guarantee you the paycheck with this small part of your assets, the rest you can manage conservatively, because you don't have to make 6-7%. You can make 4 or 5. Most money managers should make 4 or 5% in their sleep, in my opinion.
Yeah.
But yeah, for income, because most people retiring from their jobs don't have pensions. They have defined contribution plans, 401ks, IRAs, etc.
Right.
You don't have defined benefit plans anymore.
No, I mean, where I live in Northwest Indiana, we got a lot of unions from near Chicago.
Yep.
So the union guys have them, but outside of that, forget it. It's all gone.
And some of
It's
those
all
guys,
defined
if they have them,
contribution.
they're like, these things are amazing. Until they're not, you know? But at the end of the day, if you need income...
Yeah, until the pension potentially goes bankrupt, because I've seen that happen.
Until you have...
I have multiple clients who had pension programs go bankrupt,
Well,
and they end up getting 20% of what their pension was.
I think if your pension's managed by Bernie Madoff, then what?
You're getting, it's going to get $2,000 a month. Now I'm getting 400.
Yeah, I don't know about you, but
that sucks. You put your eggs in that basket.
Yeah.
That doesn't come back like a market dip.
No, and who wants a pay cut in retirement? Nobody. Nobody.
Right.
So that's the benefit behind the index annuity. If you need income immediately in the future, whatever, from a guaranteed standpoint. Now, if you are a risky taking person, then go put it in the market, and over time, markets perform. We all see it. On a 10-year run, the S&P is going to average what's going to average. You're going to have 3 years, maybe 4, of down markets historically.
Right.
But at the end of the day, tell me when those markets happen and they're down. Let me know, crystal ball, which you can't. If you do that, then we can obviously have a different conversation. We won't be here. It's like, tell me when you're going to die. And I can tell you how much life insurance to buy and what term. But we don't have that gift,
And that just really took my mind to a whole nother place. Oh man, now I'm struggling to put this thought together because
I can derail conversations pretty good. Sorry, like I said, 21 years, a lot of knowledge up there. Some good, some bad.
It'll come back to me, or I'll be able to formulate this idea. But it's you don't know when you're going to die. So one of the things I've always been a fan of is if somebody's got a pension. One of the first times I ever learned that somebody was going to get a pension, and they could take single life instead of a joint 50, let's say, are going to get $5,000 a month. But if they take the joint, they're only getting $4,300.
Yeah.
And then you could just take the $5,000 and make up that spread. That if the husband dies, let's say it's his pension, and the wife's going to get nothing, or it's a 50 and she's going to get the half. However you structure it. That you could buy adequate life insurance to cover the spread when he dies. The income either goes away because you did single or it goes in half right? That you could cover that with life insurance. Well, the problem was you couldn't cover it with term insurance and feel good about it because the challenge is what?
When?
The guy's retiring, he's 65. How much does term insurance cost right now? It's already expensive.
Yeah, 65, it's going to cost a lot. Yeah.
Right. So, But even if you got them at 55, you go, okay, great, I got you 30-year. Maybe you got them 30-year term, that was the longest, and you caught him at 50 or something. Or 50, or 60, or 70. Could he die after 80? Yeah. Could she still be alive? More likely than him.
Most
right?
likely, yes.
So that's how this works, right? So you suddenly go, that strategy is a problem. Because you can only fill that with a permanent policy.
Only, yes.
Only. And you can do it with, there's a host of different kinds of products that might make sense for that person in different situations, but it's just those kind of strategies that then you go, oh.
Yeah.
And they can use the amount, you're giving them a bigger pension, and then they use the larger amount to pay the premium.
The premiums, yeah.
And then she gets a big death benefit, tax-free.
Tax-free.
When you die, whenever that is.
Whatever that is. And the crazy thing about it, which, we haven't even talked about this yet, is like how much older people are living to.
My great-grandma died a couple years ago. She was 100.
Yeah. The number of centurions we're going to see, the right word? Centurions?
I think it's centennials?
Centennials. I don't know.
That's 100.
What's a centurion's a horse thing, isn't it? The horse
You're thinking like the American Express centurion guard. It's like a Roman guard, right?
Anyway, the number of people who are reaching 100.
Centenarians.
Yeah.
Centenarians.
Yeah, thank you.
Yeah.
Gosh. Vocabulary isn't
We is financial advisors.
I don't teach English. But
right.
The number of those is more than it's ever been in the history where we only get more and more and more.
Right.
Healthcare, science is all rapidly expanding. So I read a study from, I think it was Allianz Life, that said if you have a married couple, this was years ago, so it's probably even worse now. If you have a married couple in their 60s today, there's a 92% chance one of them lives past 90.
Whoa. Past 90.
Past 90. So 60-year-olds today, one of them's going to live past 90. On top of that, there's a 100% chance one of them will need some kind of skilled care. Nursing home, assisted living, retirement, you name it.
One of the greatest businesses to invest in over the last 10 years because they're blowing up in every
Nursing
city
homes.
all across the country. Yeah.
The active senior communities.
Yeah.
There's one being built by us. It's like 55 and up. I'm like, well, I identify as a 55-year-old. I live here. I want somebody. Can somebody mow my grass and take care of my stuff?
Dude, they got tennis courts and a pool. This place is sick.
It's got a bar. I mean, it sounds great.
How do I move it?
But that's what's happening. People are moving those neighborhoods, and you're getting good care. It's not cheap.
No.
I mean, I think the only thing that outpaced healthcare and that stuff is college tuition, ironically. But that stuff is not going away. You're going to have, we're at the tip of the iceberg still of the boomer generation retiring and the drain they will have on our economic system and our benefits programs, which is, again, tinfoil hat. My soapbox, you think about Social Security and then Medicare, Medicaid, and how grossly underfunded they are. Again, why it goes back to...
A lot of baby boomers are still putting money into it. They're not all taken out yet. What is it, 10,000 baby boomers a day?
Something like that. It's
and then it spikes at 15 for like a 5-year period. 15,000 a day, I think, on the bell curve. 7 days a week for years and years on end. It is a gigantic amount of people.
It's a lot. And so, that's why you got to look at these programs and think about, again, what can I do to protect my family, myself, what I've made, but also Uncle Sam needs revenue.
Right.
They need it. And they're going to get, where do they get it from? They can't tax the poor.
Well, they're going to take the people that got IRAs.
You get blood from the rock. Good luck with that. I hate to say that, but
I had to bring this up to a client recently. They said, "What is my RMDs going to be? The required minimum distribution. What's that? What percent is that when I turn next year?" And it starts to, for them next year, 72. I said, well, I looked up roughly what they're going to be.
Four.
It's like, somewhere in that zone. And they said, what if Social Security is a problem? Could they raise that? I said, can the U.S. government and the IRS change the tax code?
Yes.
That's a yes.
Yeah.
So,
sure can.
Because she was like, that's going to be expensive. And I was like, she goes, so what if they raised it? I'm like, it would just get more expensive.
Yeah.
So now you got to find ways to mitigate that tax liability.
Yeah.
Which is they haven't talked about it, but it's not probably on the table.
No,
in order to keep legacy programs alive, they're willing to do who knows what.
They want to go after life insurance. That's been on the table and discussed. Again, why I go back to why insurance companies are so great. They have enough lobbyist money that won't happen for a while.
It's like nearly impossible.
That's like, again, why people put money in life insurance. It's one of the last holy grails of true tax-free safe haven.
Yeah.
You got Roth IRAs, you got life insurance LERPs, where you basically, you're buying as little death benefit as possible. For those who don't know, when you're pumping into cash value life insurance, you're overpaying more than it costs. The cash value then builds upon an index-linked performance, S&P, what have you, and so on and so forth. But all that growth is tax-free. That's what they do.
I want to talk about that really quick, because a lot of people say, okay, well, you got to borrow the money. You got to borrow your own money. Well, yes, you're borrowing it. Just like it's funny, that same philosophy people hear, they'll say, well, you got to borrow your money. You got to borrow money out of a house. Real estate people borrow the monies out of commercial property, because if you take a line of credit as income, it's tax-free.
Yep.
But you're paying interest to access the equity in that big apartment complex.
Yeah.
People always talk about the real estate people do this, but you're doing it inside of an insurance program.
Yeah.
You're going to pay interest, but isn't it interest based on where interest rates are at right now? What does it look like? What are the loan rates compared to what I'm making? Is it kind of a wash? Am I losing only a little bit?
It can be. I mean, you've got different ways to look at a fixed loan rate. You can do a variable loan rate. You can structure it and see what's best for you. Every carrier will show you options. I recommend, if you're looking to do that, before you just pull the trigger, contact him and have an in-force illustration done. A lot, like myself included, I use permanent life insurance to overfund for college. I can pull it out, loan myself the money, pay off college debt, pay off kids' colleges, etc. And then if I pay myself back, great. If you don't, who cares? I'm not buying it for death benefit.
Right.
So you don't pay it back. Okay, it just goes away.
At death. It's just subtracted off the. It's just subtracted off the.
And if you stop funding it, then you don't care anymore, because you've got the cash value you wanted out of that to pay for X, Y, and Z. So it's just a matter of what do you? There's no risk to doing that.
Right. What finally connected for me was, if I'm borrowing at 4, I'm just making up numbers.
Yeah.
If I borrow at 4, and it's earning 5, I'm up 1. Okay, great. Let's say that happens that year, and you get a bump, because the index or the equity portion does well. But then if I'm borrowing at 4 and I only earn 2, I'm down 2%. 2% compared to tax rates.
Sign me up.
If it's the 4%, if you had to actually pay the 4%, that's what I was like. Well, you got to pay 4% to borrow your own money. 4% with no taxes is very different than take money out of your trad IRA, take money out of your non-qualified. I bought Apple stock at 10 grand and it shot to 40 grand over the last few years, and now I got to sell it.
Yeah.
The borrowing is a lot cheaper than all of the other options.
Yes.
Even if you are paying some points for it.
1,000% agree. That, again, back to how the rich get richer. They don't use their own money.
They borrow other people.
I mean, now, again, in life insurance, you are borrowing your own money. I get that. But you're borrowing the insurance company's money, because your cash value has grown based upon your deposits and the earnings of the index outperforming the cost of insurance, et cetera. So usually on an insurance policy, what most people mess up is they try and access cash early on.
Too soon.
Too soon.
Yeah.
There are policies you can do that. That's fine. We can help you construct that. But ideally, you got to let it cook for a little while. Otherwise,
we say it's over a decade usually for it to get to a sweet spot. Like, where's that at?
It depends. I mean, there are some products that are meant and designed specifically for early cash value plans.
Okay.
A lot of people do college funding later in life, and when you do college funding, fun fact, your EFC and your FAFSA, all that fun stuff, if it's in life insurance, annuities, or retirement plans, it's a non-countable asset. But the fact of the matter is, you got to put all this money in life insurance, and you want to access it for college, you need an early cash value plan. Typically, yes. If you're trying to grow and have as much growth as possible, about 7 to 10 years.
7 to 10 years.
Yeah, I think 7 is the minimum.
Yeah, because up front, you just got a lot of cost of insurance. Commissions are kind of baked into the ability for it to start building cash. Yes. It needs some time.
Yeah,
to get going.
It's a long-term investment, like your IRA, like your 401k. It's a retirement vehicle. It's meant to be, if you're not trying to buy and hold, we're not here in the churn and burn business. That's not what it's designed to do.
Right.
And I think when people either misinterpret that, and that's what happens to a lot of the people giving the insurance guys a bad rap. They're not bad products. There's bad advice.
Because if you set it up wrong, or you tell somebody you can borrow from this right away, and it's not set up to do that or optimized, or you're paying surrender charges or whatever. Yeah, it's bad. That was bad advice.
Yeah. Or you weren't fully educated, and you know how clients are sometimes. You've done a lot. I've never done retail. You have.
Yeah.
A lot of times they have selective hearing and they have selective amnesia.
Selective amnesia.
Selective amnesia. Like, that's not I remember. I recorded it. Here's how, it's like,
Here's the piece of paper. If you remember, we wrote it down.
I tell my advisors, record every meeting possible because that becomes a serious issue nowadays because at the end of the day, we're the experts. We are guilty first until we're proven innocent. It is not a fair shot like it used to be.
Yeah.
But yeah, the cash value stuff and holding on to that it's when you look at the numbers and see somebody do an actual illustration, you see how it works, it's like, oh my gosh. Like it can add up to a large amount of money that, again, Uncle Sam's not going to touch.
Right. I had a client who, husband, young couple, no, I mean like mid-30s, late 30s. He died in 2020, and she got a big death benefit. Was getting so much. They had 4 kids, so she was getting so much money from the Social Security from the kids that she essentially didn't need income. We had bought adequate amount of term insurance. We had all this life insurance, so she got like $800,000 of that, and we had to pay off a couple things, blah blah blah. But we were left with $700,000. So we decided this money, and she didn't even need it. She's like, I'm getting Social Security from all the kids. This is crazy. I got paychecks. I'm like, great, let's invest it. We got that money, and we put it in the market in April of 2020.
She's pretty happy.
Yeah, things skyrocketed.
I mean, the S&P's up 66%, something ridiculous.
Yeah, it is. I mean, by the end of the year, the account was ridiculous.
Yeah.
Okay, it was over $1 million in like the 12 months. Okay, so she was like, oh my God, well now we got a problem. This is all non-qualified money.
Yeah, tax time bomb.
It's great that you got $700,000 tax-free, but now we got a problem. So then you're trying to fix that from, with all the different products you can do on the fee-based side of the world and all the solutions that are over there for alternative investments, et cetera, et cetera. But it was like, oh, you know what we should do? You're young. Let's spit off some of this interest every year, pay a little bit of tax, and drop it into a tax-free product. And, that's how you get to the place where, people are paying $30,000, $40,000, $50,000, $100,000 a year premiums, but they're going to, 10-year pay, 15, you do this for a period of time, you end up with a lot of cash value that is tax-free to you to borrow and lean on in retirement. And if you don't, it's just a huge ass death benefit.
I mean, it is. I mean,
and then it recycles. The $700,000 turns into a $5 million death benefit, or whatever the number is, right? And won the whole $700,000. But
still,
little portion of that. We took a portion to adequate to alert.
It's funny because you hear stories like that, and it's like, this is a perfect scenario. Obviously, not all like that.
Of course.
But we're starting to see it. We have an advisor in Atlanta, and he's in Atlanta and Birmingham, those kind of that little area down there. And he's plugged into the NBA and NFL marketplace. He's got guys who are 2 years out of college buying $1 million a year target premium life cake because they go, oh, so if I put this much money in here for 10 years, never touch it again, it's going to be, because you have to think NFL players' lifespan is this long, NBA is this long.
NFL stands for not for long.
Yes.
You're good. Right.
It's a great scene. Who is that? Was it Atlanta Falcons coach?
Falcons coach said that?
Yes, it's to a ref,
yeah.
But they're starting to see the benefit and going, because you got to think, you come from where a lot of players came from, they get that first big check, and they see what Uncle Sam takes, and it's like, oh, pardon my language, oh shit, this sucks.
Oh, taxes are a real problem? Because if you're not coming from money,
no,
you've never really experienced it until you make some money, and then you realize taxes suck.
There was who was the guy for the Pittsburgh Pirates? McCutcheon? Yeah, had the dreads.
Oh yeah.
He showed a pay stub, not how much he made, but all the taxes that came out. Because every state you play in, the way they do it in MLB, you pay that state tax on top of everything else.
Where that game was that you earned the dollars from that game. Got it.
But it's funny because my point is like, yes, it's for the wealthy and those stories, but they're starting to see and go, this sucks. How do I get this out of my life? Here's how you do it.
Yeah.
Or they go, okay, I'm probably going to play a max of, this one NFL player is very well paid. And every year he gets they read his salary to be a bonus program. He gets about $15 million bonus check every year in the next 4 years.
Okay.
$2 million into an index annuity, $1 million into a life policy. He just built his own pension.
Yeah.
And he built a tax-free fund. And he's like, okay, cool. So in 5 years, he's the next Bobby Bonilla. He gets the $1 million check every year, Bobby Bonilla Day. He just built that for himself.
Yeah, and he's also not watching the market.
Doesn't care.
Well,
Again,
the peace of mind involved in that side of it too.
Back to the fee-based idea. If he's making $15 million a year, I'm taking 3. I'm taking this 20% of your portfolio per year to buy this, which is going to happen. I say it happens hell or high water. It's going to be there. There's no market decline that erases it. There's no changes to tax code. This is here. You now have, 12 million to do whatever you want to. Same as from the fee-based guys. But listen, if you have clients wanting to take income and you got $1 million portfolio and they need $100,000 a year, or they need how much money? How are you going to do it? Say, well, let's carve off this much money. In fact, one of the insurance carriers we use has a great calculator that shows how to de-risk your portfolio and shows if we were able to put this much money into their annuity to generate this much income, your portfolio only has to earn 3.68% net of fees to do this.
Yeah, right.
Would that make your life easier? You're not worried about keeping things in cash positions to liquidate to give them the income. They're not calling you to say, hey, I need more money for this.
Right.
It gets to kind of autopilot itself.
Yeah.
So anyway, that's my 2 cents on that subject.
What do you think is happening to the industry? Have you been seeing in the IMO world, or financial advisory, I don't know what the study is right now, average advisor, financial advisor is like 59 or 60 years old.
Yeah.
Right, we're actually young. When you're saying we're talking about cell phones, they're talking about like kids' cell phones.
Cell phones.
I remember back when we had one phone in the office, we all shared it, kind of stuff.
One,
right.
7.
So, I mean, that's a real thing. Like in the RIA space, BD for sure. The broker-dealer space has broker-dealers going out of business every month across the country.
Yeah.
CPAs, same problem. It's a real challenge. We got the baby boomers leaving the industry. We don't have young folks coming in behind. That's on the advisory side for sure, in the broker-dealer side. Insurance, a little lower barrier to entry, just because it's simpler test and that kind of thing. But is the industry recruiting on that side? Are they struggling? Do you pay much attention to that?
So a couple of things. Let me look at it a few ways. One, in the IMO space, you're seeing a lot of aggregation.
Okay.
A lot of PE firms gobbling up as much distribution as they can. And there's about 3 or 4 major players that are PE backed. PE being private equity.
Same in the RIA space.
Same. And you're seeing, and we are fiercely independent. It's in our name. I mean, Financial Independence Group is our company. We are fiercely independent. We acquired a smaller IMO that's only in the bank channel because our world isn't in that space. And our competition isn't in that space. So we don't buy just to aggregate production. It's like, okay, this is the field we aren't in yet. We can then penetrate that space. Great.
Got it.
But you're seeing a lot of aggregation in the IMO world, and you're seeing the investment world. You're seeing Cap Trust buy up all these RIAs. It hasn't come down to in my opinion, the mom and pop individual spaces yet. You're seeing the big boys.
Yeah, right.
You're seeing like, I just saw one the other day that was like a $12 billion RIA merge under somebody. I'm like, that's so much money. Like $12 billion is a lot of assets.
Fisher Investments is selling.
That's a couple.
To Middle East money for $12 billion sale.
I think
now that's not a consolidation or an aggregation, it's a sale, but good night. I mean, that's
a lot of money.
That's a 21x earnings, 21 times earnings on their revenue.
But I didn't know that about Fisher, but good. He hates annuities, but fine.
Get him out of here.
Fine. But fun fact, Ken Fisher hates annuities, but he owned American equity stock. So turns out these insurance companies are also pretty valuable. So I'll buy their stock.
It was in all the portfolios for the clients, but
it's it's crazy to see what's happening in that space. I think we are going to have, right now, you don't have enough, the supply and demand aren't in sync yet in that world. Prices are outrageous. A 21x multiplier is insane.
Right.
Most people in the, like if I'm selling Walker Hand Financial, you're seeing 3-4x.
Well, for individuals,
Yeah.
yes. For big platforms, it's different.
Yeah.
Yeah.
I mean, I don't know what Schwab bought Ameritrade for or vice versa, but that had been
It would have
pretty
been a big
ridiculous.
number. Yeah.
You're seeing consolidation, only because, like you said, this aging demographic of the 56 to 60-year-olds haven't done good succession planning.
So that guy wants out.
Yeah, he's like, well, I don't have a junior advisor that wants to buy it. My son or daughter is off doing whatever. They don't want it.
Right.
And so, okay, I'll find somebody to buy it. And that's when you go put on to these succession links and these different websites that have like an eHarmony for
financial
advisors to be bought and sold.
Yeah, which is part of what we do at Terra.
Yeah.
We're an aggregator.
Yeah,
Right. But
and I think it's if you can be the one doing the buying, it's great because you can offer them a good buyout,
And a way to get out.
a golden handcuffs. But you're just seeing more of that where they don't have a succession plan. Most of them were great at gathering assets. They built this thing up. Now it's like, well, now what?
right.
Yeah. And you give them a 3 or 4x on a $100 million practice. Here's a couple $1 million.
I just think it's fascinating that I can't remember how many doctors there are. It was like 2 million plus doctors or some psychotic number, and there's like 250,000-ish financial advisors in the country.
Yeah.
Like there's only a small percentage of us that are sick at any given time, but like everybody needs financial advice all the time. Mm-hmm. And statistically, most people don't even have an advisor in their life. And statistically, we don't have enough advisors to make that happen, even if we could.
Yeah.
There's not enough people even in the space to manage the supply and demand so out of whack. I would say that's not probably a topic for today, but it's a problem. Like, I don't know how we're going to fill that need, because if we're talking about, let's call 300,000 advisors who are really in the space, not back office fidelity.
Yeah.
They're licensed. It's a bigger number than that, but the real in the field people,
gathering
retail,
assets, writing business,
managing clients and assets. That it's like 300,000-ish. Okay. If you're saying the average of that number is 60 years old, we got a problem.
Yeah,
because that number is already too small. That number should probably be over 1 million total advisors comfortably nationwide to fill the need that actually exists. But it's 300,000, and you're saying half of those could go away in the next 5 to 10 years. I think as a business opportunity for people in their 20s and 30s, if you're looking to make a career change, I think it's one of the best career changes you could possibly make right now. As an opportunity, I think it's psychotic.
Yeah. I've told my kids, they always ask what I do. Most people have no clue what I really do.
Don't get it.
I'm not sure my parents understand.
My mom's always like, hey,
he's something in finance, insurance.
Talks to people about money.
But I've told my kids, like, if you wanted to get into that world, like I would for sure look at when they graduate college. It's like, okay, I'd go buy a firm for them to work with me as I'm getting out, that they can then run and manage. I mean, you're right. There's a need for it. The fear is regulation, and stuff. At the end of the day, guess what? Money's always going to be around. Taxes will always be around. People are going to need advice.
Yep.
And, whether you like it or not, it's not going to be a world overtaken by robo-advisors, because not everybody deserves American funds and term insurance. No disrespect to Dave Ramsey.
Right.
He fits a lot of people, but not, it's like a doctor. Not every client you see gets Lipitor or gets Prozac. They get, everybody has different needs. And I think the advisory space provides that. I mean, do I think they can legislate morality? Of course not. And unfortunately, you do have bad apples. But on the whole, those advisors, there's a lot of great ones out there, and they're giving good advice.
Yeah, I mean, I've been in the space 18 years. Most financial advisors I've ever met are like really good-hearted people who want to do what's right. They want to help people to the best of their knowledge. That doesn't mean they always have the knowledge. I did that for a long time. Can you say you hurt somebody by giving them a large amount of term insurance and putting them into equities, in fixed income? No. It's just, that wasn't hurting anybody. But were you optimally help. Sometimes you kind of round peg square. Are you making it happen?
Yeah.
For sure. Which is why, like, I'm big on hybrid. I think it's important. Like our firm, we have an RAA, we have an affiliation with a broker dealer, and we're fully in risk management, like a national carrier with you guys. I think you probably need all of those because there's so much legacy BD out there. You run into clients, they've got that stuff.
Yep.
Somebody needs manage it. You've got stuff that can then go fee-based, and the same client then may or may not need fixed products and insurances too. I think it's really hard to do the full job without those. It just means that you do have a conflict of interest, and you just have to talk about it. You just got to be like, look, I can make money this way and this way and this way. Let's talk about it. And, but I think you have to have that in order to also go, I can truly look at this from 30,000 feet down on this person's scenario and figure out what's the best thing for them.
I wholeheartedly agree. And I've always, my team back at FIG always laughs. Like, I'm not the guy that's going to fix everything for you, but I know the people.
Yeah.
I think as an advisor, if I was ever going to be a retail advisor, that's one thing I would try and pride myself on is here at Walkerham Financial. It's like, I'm not going to be the guy that has all the answers, but I'm going to know the people that do.
Yeah.
And I'm going to get you in touch with the right people that I trust and you can trust to give you what you need to have to make an educated decision that best fits you and your family's needs. Not my needs and my wants, your needs. And I think that's where most advisors could provide a lot of value, is having a really good tax attorney, estate, those type of networks where you build that trust. I think by a lot of guys, that family office model is appealing.
Yeah.
Where it's like, I go to my guy and he takes care of everything.
Yep.
I don't care who does what, he quarterbacks it, and then he goes, hey, we did this, he has it all lock, stock, and barrel.
Yeah. Well, that's one of the real hopes of this podcast, the Advisors Collective, is we have financial advisors on the show. We have people from the financial advisory space, fee-based only people, BD people. I'll have, this is only episode 4.
Yep.
So we're talking risk management a lot today and really heavy on that, but also estate planning attorneys, CPAs. So we're going to get those people who run family offices. Like, how do you build that into your ecosystem where you're at? If you're independent, you can do it. If you're maybe captive somewhere, like, how do you maybe make that work the best you can for your clients under your company's compliance systems?
Yep.
But which gets a little grayer and harder because there's procedures and everything everywhere. It's a little bit different, but I think that's kind of what's required nowadays to actually do what's right for somebody, is to have your hands to be able to look at all those different aspects, because if anything, money's becoming more complicated.
It is. There's more areas to invest in, more things. I mean, you got crypto, we can touch that, and that's a whole other can of worms.
Right.
I mean, you got guys in this building who are just crypto traders. I know nothing. Like, my buddy's like, you should buy Bitcoin. I didn't. Now I'm like, well, I should have bought Bitcoin. But then what do you do with it? Do I put it in my Venmo? Like, where's it go?
I haven't learned anything about this.
How do I unwind this web, and how's the government going to tax it? But you're
still unknown.
It's still unknown. They're going to figure it out.
Oh yeah, they're going to figure it out.
They're going to get their money. But I think you're right. I think the way you guys have built Terra with the RA and the BD affiliate and the risk management space is like, all right, we're covering these. What's next? What else should we do? It's like one of our firm we bought and started was a property and casualty company. Think about this: you're managing a client who's got this much money, and they have a catastrophic car wreck and they get sued. How are they gonna pay for it? Where's it come from? Their assets.
Yeah.
So why wouldn't you make sure they're properly insured? You aren't going to be a PNC agent. No. But I want to either A, have one in-house, or know that my buddy who is an independent agent for, maybe he's with Erie or whatever, he can offer others. Hey, make sure the Joneses, talk to them, let's audit their insurance, not life insurance, audit their umbrella, their cars, their home, auto, whatever, to make sure if something happens, they're insured.
They're insured, yeah.
And so things like that, where I think a lot of advisors are starting to look outside the norm box of just, I'm an equity, insurance, and annuity guy.
Right.
It's like, we got to offer all that, because now wealth management, it spreads out like a spider web. Where it's like, now it's into your PNC, it's into your home, it's into your vacation rental. What if you have a rental house, slip and fall, they sue you. What happens there?
That's back to the complication, which is why I think you have to have a team, an office that's like a team system, because how is one advisor supposed to learn all that crap? I mean, which is where then you have to come into how do you put enough people around you that know those given areas, the tax guy and so on and so forth, so that you can provide all the solutions, but you don't have to. You can stay in wealth management. Like that's your lane.
Stay in your lane.
You stay in your lane, but you got to have the resources for those stuff. So, anyways, it's been a lot of fun.
Yeah, man, this is cool. Awesome. Next time we'll have cigars. And
next time, we'll make sure we're in the right place to be able to do that.
Maybe a little golf course live action. Who knows? The world's our oyster. We can do whatever we want.
We have our own camera, and I have my own podcast. I do whatever the hell I want.
I make the rules.
I make the rules. Well, hey, thanks for watching. You can, if you haven't already, subscribe below and hang out for the all-important disclosures at the end. Thanks a lot. See ya.
Appreciate it.
See ya, Walker.
Thanks, buddy.
All right, welcome to the disclosures for the Advisors Collective. The conversations on this podcast are intended to provide financial advisors with ideas, strategies, concepts, and tools that could be incorporated into their advisory practice. Advisors are ultimately responsible for ensuring implementation and compliance of anything discussed in accordance with your regulatory and compliance responsibilities and obligations. These discussions are meant purely for educational purposes. None of the information heard should be taken as financial advice or planning. The conversations and opinions that are expressed in the show are that of each host only and do not necessarily reflect the opinion of the other hosts and their affiliated companies. This podcast is not intended to give tax, legal, or investment advice. Always consult with a qualified professional. For my practice, securities are offered through Cape Securities Incorporated, member FINRA, SIPC. Investment advisory accounts are offered through Terra Wealth Management.